the amazing thing about these treasury curves is that there's literally thousands of economic agents, and they're not essentially engaged in this kind of binary buy sell. There's hedging, and there's just a whole vista of choices that have to be made, commercial risks that have to be controlled, and the pricing therefore is the distillation of all of that wisdom, and therefore no surprise, I believe, that it carries greater weight than a collection of individuals meeting every 5, 6, 7 weeks and trying to determine something. So we have a lot of market wisdom which is urging caution, and it is being rejected. I mean, I had to laugh this week reading the Financial Times. The front page had the deputy managing director of the IMF and saying that they changed from, their view was great caution, consternation about the year 2023. And I was like, yeah, by the end of the year, we're going to be partying again. And I watched a movie last year, The Triangle of Sadness, which is, I'd recommend it to people, not for entertainment purposes. It's kind of like a political polemic. But they have a bit of a satire at the beginning on male models. And it begins with where you have to say Balenciaga, and you look very ponderous. And then you say H&M, and it's Balenciaga, H&M, and it continues to this end. And that's that is like the releases you get from Jamie Dimon, from the IMF, from the Federal Reserve, Balenciaga, H&M, okay? And where are we? The Fed's kind of saying, hey, look, the economy's very H&M. We're all having fun, and we've got to make it Balenciaga. The market's been telling you since mid-year last year, like arrête. And with this notion of going beyond 5. So, yeah, I'm a simple guy. In the 1970s, we know that they took the rates to 20%. But we also know that the 70s was the end of a profound deleveraging, global debt deleveraging, which had commenced in the early 1930s with the bankruptcy of the United States financial system. And we went from 3x debt to GDP to 1. Let's say 1 or 1.2, but let's say 1. Yeah. And so if you will, in my simple mind, the 1x debt to GDP times the Fed funds peak of 20. 1 times 20 is 20. Today, debt to GDP, depending on your persuasion, is 3.5, 3.6 to debt to GDP. Let's call that 4. And the Fed is pretty close to 5. Determined it would seem to hit 5. 4 times 5, 20. Like, to my mind, we're at the equivalent of 20% rates as we were in 1982. The highs in, and we're going to see the effect on the economy. I think we are seeing the effect. I mean, the inflation prints are going to be, we know the inflation prints are going to be very, very low.
Yeah.
And it's the consequences. It's what that brings on. If they've gone too tight for too long. Microsoft. Anyone heard of Microsoft? Microsoft yesterday laying off 10,000 people. Now, take that on board. That is the very last thing a corporation wants to do. Do you know how hard and the expense of trying to get the right people to get them on your team? And then you got to trash that and get rid of it. It's so disruptive. It's the last thing you want to do, and you only do it when you go, yeah, this economy is in the sink. It's going down. The Fed, may I remind you, brought rates down from 5.25 to 0. Yeah, in a hasty retreat. From like August, September 2007 into early 2009. What did stocks do? Stocks plummeted, right? When these guys slash interest rates with the tail between their legs, like, oh, darn, we got it wrong again, and they're like, cut, right? eventually, you know, they had to come in with QE in March. You know, I remind you, Citigroup was pre-split was trading as a penny stock. I mean, they were all gone. They were toast. I mean, this is what happens when the Federal Reserve tighten. I mean, could be worse. Could be the ECB. I mean, the ECB raised interest rates in the summer of 2008. I mean, oh my God. You're like, again, there are very, very few intelligent people in the world of finance and indeed in the regulation of finance. And that is the biggest unspoken risk that we're all underwriting. For me, this market is it's very, very simple. You don't own equities. I think there's a huge upside in the long bonds. You can buy the ETF, the TLT. So you're getting like almost 20 years of duration. If you look at the price there, it's not like it's retraced to like 2018. It's not retraced to like 2014. It's retraced to 2004. I mean, it's a gift. It's gone 180 to 100. Everything is fine. The big problem is inflation. The IMF, Jamie, the Fed, all these guys that never see it. Good luck with that. The S&P dropped. I don't know the precise metric, but close on 60% peak to trough. Mm-hmm. Give me a 60% haircut. Yeah, you could say there are tech stocks. Snap, I think, is down almost like 90%. But I mean, there is a big question mark on its business model. The Facebook Meta is down about 70%. But they're individual names, and there's a lot of specific risk. S&P is down what from the high? I don't even think it's down 20%. Is that the greatest buying? Is that the greatest buying opportunity ever? Gold was very kind for me at the beginning of my hedge fund career, and I managed to nail a 50% calendar year gain in 2003 when gold eventually took off, and I found myself again in conflict with central banks in the United Kingdom. They were selling all of their gold, and I was buying it. Gold looks chart-wise, gold looks good, and the relative chart of gold to the S&P looks amazing, and gold in all the other currencies bar the dollar looks amazing in terms of new highs. And even in the dollar, I think we're 12% off an all-time high. Why? Why? Because it is a damn silly asset. And it typically does well when real treasury yields are negative, and they're depending where if you measure real yields taking the last CPI, but we don't do that. If you look at the average and the 5-year forward inflation break-evens, rates have turned positive, and that's what's slowing the economy. So I think the performance of gold is telling you. I think it's very similar to my belief that the TLT is going to tumble. I think it's predicting that the positive real yields engineered by the Federal Reserve will prove very, to use that word, transitory, and we'll have to to pull ourselves out of the train wreck. We'll need deeply negative real yields again.